What's up, everyone? Erik here from Outlier Trading, and we are following up with another video on our trading options with a $5,000 account series. This one's going to be talking about buying single options. Now, the last video we did really talked about the landscape for a $5,000 account, some best practices, things to keep in mind. So if you haven't seen that video, highly recommend checking it out. We can throw a link in the video description below for you. Today's video is going to dive into 5 specific things. We're going to talk about common mistakes and misconceptions with respect to buying options. We're going to talk about why people might buy options. We're going to talk about a brief overview of long, call, and put positions. Now, this is going to be a gloss over. The understanding for this video is people are probably coming into this at least with an Investopedia level understanding of long options. So this is just to touch on them very briefly. Then we're going to talk about these things I call profit mechanisms, which are specific market effects that we're trying to capture. And then we're going to talk about putting it all together. Now, as always, before we get too far into the weeds here, we're going to start with a disclaimer. So I am not a financial advisor, nor am I part of Barchart. Simply enjoy creating content to help increase your awareness, your understanding, the information at your disposal. So let's get into it. Let's start with some common misconceptions. Now, for this section, I'm actually not going to answer these up front. I'm going to show them to you. And then throughout this video, you should be able to answer them for yourself. So the first one is buying options too close in time. This is a big mistake. Next one, selecting the strike price for your option based on where you think the stock is going to go. So an example of this is if I grab a chart of something like Palantir here, and let's say it's at 111 and I think it might go to 120. The common misconception here is defaulting to buying the 120 strike call, which is a mistake. The next thing on our list is not paying attention to liquidity, overvaluing volatility of your option, undervaluing volatility of your option. You'll understand what those mean in a little bit. Not accounting for theta for long options, lack of using the Greeks to optimize your positions, which is going to be part of our prac app at the end, and then not having a management plan for both profit and loss. So these are your common mistakes. By the end of this video, you will be able to at least have a game plan to overcome literally all of them. So now let's get into why buy options. There's kind of 3 big reasons. The first one is they provide leverage. The second is they maintain defined risk, meaning the most you can lose is whatever you put into the opening position. You can also use them for hedging. So all 3 of those sound really good. What's the trade-off? Well, the trade-off is this leverage is not free, and it comes by way of things like theta decay, which means as you hold your options, they are going to slowly erode in value. There are ways we can minimize that though. Now, this is just the risk profile for a long put and a long call. The Cliff Notes version is long put makes money as the security goes down and it has defined risk to the upside, meaning if you're directionally wrong, and long calls are the inverse. So this is essentially a way for us to take a defined risk level directional bet. Calls for the upside, puts for the downside. Now, let's talk about this idea of profit mechanisms. What is a profit mechanism? It's the specific modality in which a trade makes money. Now, this might make sense. It might be like, yeah, no, duh. But here's the problem. You will find as we go through this example and as people start getting into trading options, you will find traders say things like, oh, well, volatility is kind of high. I don't want to buy a call or buy a put. This is actually putting the cart in front of the horse. And again, you'll see why in a little bit, but it has to do with identifying the primary method these trades make money, which is direction. Then the profit mechanism types. This is how we categorize the profit mechanism. So if we have profit mechanism in this case of price direction going up or down, it doesn't always look the same. So if we take a look at, again, Palantir, and we take a look at a 1 month time frame, and then we go into these different periods, right? Notice how price ground up during this phase. And over this period, price went from 65 to 81, a pretty solid move. But then notice how after this most recent earnings, well, the last earnings release it's had, it went from 83 and it just jumped up to 104. And then it just had another really strong post-earnings move. What I'm trying to highlight for you is that not all profit mechanisms, especially price directions, they're not the same. They have different traits and qualities, and you have to differentiate those. And here are a few to get you started. Things like momentum, drift, breakouts. Those exist in the market today. There's a lot of research out there about literally all of these, but they behave slightly different from one another. So now let's talk about how you can at least structure all this in your mind. The way that I do these things are through something called a strategy outline. And what I do is I open up a Word doc, and for the strategy that I'm trying to define, I create these 4 sections. We have an executive summary, which is filled in after 2 through 4 are done. Section 2 is about the setup. Section 3 is about management. Section 4 is AAR. This is a military term, after action review. And this is essentially how we track and evaluate what we did. The whole purpose behind this strategy outline is plans themselves rarely are followed perfectly, but there's an insane amount of value in the planning process. And you'll notice as we get into the tips and tricks and the practical application we're going to go through in just a second, the planning process is really important. So this is a way to facilitate that planning process. So once you go through and you figure out how you want to set up the trade, how you want to find the tickers you're going to trade, the way that you're going to analyze it, things like that, and you figure out how you're going to manage your profit and loss, you're going to manage by time, you figure out what you want to track, then the executive summary is no more than 3 sentences, should be 1 to 2. And this is to succinctly summarize the way that this strategy works for you and your trading book. And the whole purpose here is it's a proof of concept. If you can't summarize up what you're doing in just a couple sentences and you need to write a paragraph in order to describe it, either it's too complex or you don't understand it that well. So this is a proof of concept section. Okay, so now we understand long puts, long calls. We have an idea of their risk profiles. We understand this concept of profit mechanisms and profit mechanism types, and that it's worth our time and effort to differentiate these so that then we can build trades that capitalize on the profit mechanism more closely. So now let's get into some tips and tricks, and we're gonna dual hat this with a little bit of a case study together. So the first thing to keep in mind when we're buying options is that it's very similar to buying or selling stock. What that means is the same kind of analysis that you would apply if you were buying stock essentially applies to options. So if you pop open a chart and you like to conduct technical analysis and you care about the slope of moving averages and you care about volume profile and you care about RSI and whatever the things are that you conduct your analysis based on, it's the same. The only difference is we're overlaying options positions at the end of it. So let's take a look. I'm going to pull this over into my trading platform just because it's a little easier to see and hear what I'm talking about. So let's continue with this example of Palantir. And let's say that after its most recent earnings, you really like it, it gapped up big, and you're like, man, I would love to be able to trade this to the upside with long options. Well, one of the realities with a $5,000 account is you're going to have to be really, really thoughtful in terms of what the price is of the underlying you're trading and if it makes sense. Because let's say, based on this breakout strategy that I'm trading here, let's say that the stop for the trade gets placed at 99.05. This is essentially, if it falls below this range, that's simply saying that my idea was wrong. It's time for me to get out. Well, if we come into the analyze grid really quick and let's build a trade really fast. I'm not going to go into the details just yet. I'll explain why the trade's being built as it is in just a minute. But let me show you really quick. So if we drop that price in there of 99.05 and we see that the loss at that point is $674 for a 1 lot. Well, if we go back to this and we're trying to develop a price and time management based plan for our trade, trying to balance expected returns, there's a reality for smaller accounts. Smaller accounts are going to be constrained. And in my opinion, for larger accounts, we typically would risk something like 0.5%, 2%, 3%, something like that. You can go higher than that if you want, but it really depends a lot on the strategy. If we're trading a strategy like this that has a really high likelihood of being wrong, meaning this is a really speculative trade, it could very easily roll back over, or if it's a lower conviction trade, then we try to err on the smaller end of this risk management approach. And if it's something that's more thematic and it's a slightly different style approach, longer term in nature, then we can size up a little bit with respect to the total risk. But for smaller accounts, notice how much bigger this number is just to start. And it's because a smaller account is kind of going to be oversized right from the jump. But we have to do our best to make sure that a small account has a chance to get on enough trades, enough looks at the market that are well structured to allow the strategy to bear out in the long run. Because in the short term, you could put on a really great trade that was well researched and you could just be wrong, just because sometimes the market will do that. And if you size too large, you don't give yourself a chance to get enough looks for the actual performance to bear out in the long run. You can have a bad path where you just happen to be wrong a few times in a row, and then you can seriously erode the account. So to recap all of that, when we're trying to figure out the management plan, for a smaller account, something like 2 to 5%, I think, is logical for these kinds of trades. So if you think about a $5,000 account and you think about trying to essentially manage your risk at about $100. So if we go back over to this example for this Palantir trade and we go to this and you see, well, it's $674. It's literally over 10% of the account in a loss on a trade that might be pretty high probability. So this now doesn't fit the portfolio. It doesn't really make sense. So when we're trying to find things that make sense for a smaller account, one of the things we can do is use this tool from Barchart, this screener, which I really, really like. And you can find things that are priced a little more appropriately. So let's say that we want to take a look at things that have done well over the past year. And we're going to see what's carrying decent momentum because that's the style that we want to trade. And if we take a look through some of these, we can find some cheaper names that might fit the portfolio better. So let's take a look at something like BBAI. So if I come back over to the platform and we drop in BBAI, let's say that you like this ticker, and let's say that after its most recent gap up, you kind of want to trade it to the upside. Let's say that you're going to plan on managing risk if it comes down below this level. In reality, I probably wouldn't enter a trade just yet. I would wait to see how it behaves here, but just for the example. And let's say that we eyeball our stop in the strategy would be, we would get out at 535. Okay, so now let's take an eyeball at actually building a trade in here. We can again go out a little further in time. And now you might be asking, Eric, why are you going further out in time? And it's because if you recall earlier when I said theta is essentially what you're paying for that leverage, we have to minimize our exposure to theta. Otherwise, it erodes too much of the value of your option. Theta really starts to accelerate once you're within 60 days to expiration. So if I'm going to put on this trade and expect to hold it for a little bit, I need to be a little further out in time, essentially, so that I can close it as it gets closer to within 60 days. Because remember, I said for options, we have to manage them both by profit and loss, meaning our price targets, but then also by time. There's a time component to these trades. Now, what's the trade-off of going further out in time? We're going to give up some gamma. Gamma is the ability for delta to compound. So this is also why it's really important to balance what you're trying to accomplish. Because if I'm trying to trade a really short-term move, maybe I want to actually come in a little nearer, accept the higher theta decay in the anticipation of getting a faster move. And if I get the move quickly enough, then it can compensate for it. This is the balance, and this is how we can use the Greeks to optimize our trades. And if you're interested, we could do literally an entire video talking about how to use the Greeks to optimize your trades. But let's finish this example. And let's say that you're going out 99 days, you're picking something that's over a 50 delta because it's going to have slightly lighter gamma because it's further out in time. So we want good delta movement. and we analyze this trade. And we already know what our stop point, as we listed, is 535. So let's add that down here, 535. And let's see what we would lose. We would lose $84. So all of a sudden, this fits within our risk control parameters. Now, let's say for the example, instead of putting your stop all the way down here, your stop was further up here. You're being more strict with your stop. Well, if we do that, then that simply means we can size the trade up a little bit. So now we're looking at 663 for our stop. So we'll add another slice here. Let's take a look at 663. And we lose $12 there. So if we're trying to stay below 2%, which would be about $100, we can size this up to anything up to like an 8 lot, which would take you up to $99. Now, again, that's a really high probability of getting stopped out. So I would actually want to be on the smaller side of that scale. But this is how we can fit the trades together. We can balance how we're picking our risk management levels and then sizing the trades appropriately. What we just went over for calls is the same thing for puts. It's just based on your directional assumption. So if you're interested in a follow-on video where we can dive deep into using the Greeks to optimize your trades, let me know and we can make it happen. As always, if there's any questions, throw them in the comments below. Be an outlier. We'll see y'all later.